Hey everyone, me Kevin here. In this video, I want to go through something that could end up making you a lot of money. And no, it's not trying to pitch or sell you something, though yeah, there are links down below where if you wanted to buy something, you could. This is to show you something in a not so granular way, not so overwhelmingly detailed way. I just want to talk to you as a human and talk to you about the big X that I see happening, or the great crossing between real estate and stocks. And now, while we've talked about this a little bit on the channel before, maybe you're new here or you haven't seen the dates that I've put on this yet. So I think this is a really critical video for you to watch because it could make you a lot of money. Let's pay attention to this. I think it's going to give us a lot of information. Now, just this morning, which kind of relates to what we're going to talk about here, we got numbers that would affect the stock market, and we got numbers that affect the real estate market. And it's really interesting to just use these two data points from this morning because it is not only fresh information, but it also reiterates what I think is going to happen and the timing for what I think is going to happen. So first of all, we're coming off the end here of earnings. Q2 earnings season has been phenomenal. I mean, even Apple that told us, hey, expect a big miss, came in with a beat over that miss. And we've seen that across the board for many, many freaking companies, which is awesome and really exciting if you're exposed to stocks. I'm 98% invested in the stock market and real estate. I've got like 2% of my portfolio in cash. And so I'm excited about this. I'm excited that it looks like the stock market may have bottomed in June, though only about half of you believe that. I ran a poll on Twitter, and about 55% of you think this is just a bear market rally. 45% of you think, no, we bottomed in June, and this is it. We're going back to the moon. Okay, interesting. So we've definitely got some, arguments on both sides here, but this video isn't to try to argue the bottom of the market. It's to argue the intersection of stocks and real estate. And let's talk about those two data points, and then let me talk about that intersection. So 2 data points came out this morning, and I want you to think about which one is good and which one is bad. So first, remember, we're in a technical recession, right? 2 quarters of negative GDP. And what came out? Industrial production came in and beat expectations substantially last month. So what is industrial production? Well, industrial production could be machinery. It could be building chips and components that go into things that we use, like the Apple iPhone. There are a lot of components within this that are produced by industries or manufacturers, I should say, within industries, and then Apple buys them and puts them together and sells us a good. Generally, when we see industrial production rise, it's a really good leading indicator. Think about it. If we're in a technical recession, it means things have kind of gone down. They've gone negative year over year, right? Now we're seeing industrial production rise. We're actually seeing earnings come in stronger than expected. Consumers are holding up. They have more savings than they did in 2019. They're still spending more than they did in 2021, 20, and 2019. And if anything, even though spending slowed in March and April when we kind of hit like peak fear in inflation worlds, we've actually seen consumer spending tick back up again in every single income demographic. So consumers are spending, and in my opinion, industrial production rising is a sign that companies like Apple, just for an example, are picking up the phone and going, hey, yeah, we're gonna have to order twice as many wafers as we thought we needed. Oh yeah, hey, glass screens? Yeah, 3 times as many glass screens. Make sure you put the the crystals in it this time. We need them for the advertising. Basically, now they produce more and we see industrial production rise before more product comes to store shelves and consumers can buy more. It's a leading indicator that's good. It's actually a green flag, so to speak, for the market instead of a red flag, right? So we're seeing these more and more. That is, consumers still spending, green flag for stocks. Earnings coming in way better than expected in Q2, green flag for stocks. Industrial production, green flag for stocks. The inflation readings, while still ridiculously high, 8.5% is still ridiculously high, right? We're seeing kind of what could be a potential peak, but even if we just stabilize for a little bit, if our underlying companies and industrial production keep booming. Now, some folks are rightfully concerned that, wait a minute, Kevin, like if we're seeing those green flags, consumers still spending and industrial production still going, isn't there then a risk that we actually continue to add more inflationary pressures, and that's just going to make the Fed have to come out and punish us more? And the truth is, yes, that is absolutely possible. Fortunately, though, we have the benefit of commodities across the board plummeting. Nickel, copper, lithium, wood, wheat, oil, gas, you name it. Like the big things that caused a lot of inflation are plummeting. And something that folks really forget a lot when it comes to inflation, and then we're going to talk about the crossing, is the following. Look, when inflation goes up, and I hear this argument over and over again, it's like, hey, if you pay people more, it's not like you can undo their wage increase to get inflation to go away. You don't have to. And I think this is what a lot of folks miss, is you don't have to. See, look, if you pay somebody $100 in 2021, and then in 2022, you pay them $110, that right there represents a 10% increase. If now in 2023 you pay them $110, the same level, inflation is actually 0%, right? That's what's so important. That's what's so critical, is not the fact that wages and prices went up. It's that they then stabilize. Even if they go up $1 or $2, less than 3%, that would be okay. Now, if we continue to see, now all of a sudden this is 121, another 10% increase, that's a problem, right? Now we get into spiral world, and then we get Paul Volcker, basically the image of the most severe Federal Reserve chairman, to come out and just spank markets and put us into a deep, dirty recession to prove that inflation will be going down, even if it means burning the economy to the ground. Well, that's a bad day. But we don't have to talk about that, because that's not what we're seeing. It's not what we're seeing in commodities. It's not what the bond market is yelling at us. So where does that leave us? Well, that leaves us with a lot of indications that inflation should continue to trend down. Companies and industrial production and consumer spending actually holding up really well for a recession, much better than expected. So that's like good news on inflation, good news on industrial production and consumers and companies, right? That's really, really important for stocks. But what about housing? Well, housing, we already know this. I'm not going to rehash this because I made so many videos, but just to catch you up, more price drops in every city across the country. We're actually starting to see closing prices finally start ticking down. When closing prices start ticking down, you get more fear in markets. Or I should say, fewer homes are built and more deals are canceled, leading to more inventory on the market, more discretionary sellers, people who wouldn't have to sell but can sell, deciding they're going to sell and move into another home that they have, or with family, or move to a cheaper area, right? All of these things can happen to lead to more inventory hitting the market. Of course, we all know all real estate is local, but what numbers came out this morning? Well, this morning we had a really bad reading. We had, so housing starts are basically when builders start building new homes. This is different from building permits. Let me quickly explain that, because this number is going to blow you away, okay? Building permits are when architects go into the city and they say, hey, we've got all these beautiful plans that we've been working on for the last year. Here you go. And then the city's like, my goodness, these are some beautiful plans, but we don't like that one thing. And they send it back to you for 6 months, and then it goes back and forth, and it takes like 3 years for you to get a permit. Building permits are kind of a weird number because they're not quick. People look at building permit numbers, which actually slightly beat this morning, but folks look at building permit numbers, and I think that's somewhat of a leading indicator. It's a terrible indicator for the housing market, because building permits are a way of suggesting that, hey, finally, through the pipeline, the cities have caught up and issued permits on plans you could have submitted 2 years ago. It tells us nothing about what actual home builders are doing. But you know what does tell us something about what home builders are doing? It's called building starts. Building starts is, hey, all right, we're breaking ground and we're starting to pour the foundation. That's actual construction started. Okay, that matters, because now people are putting money into that project. And we were expecting a decline on this number. We were expecting a decline of 2.5%, but we actually got a decline reading of 9.6%, nearly 4 times as bad of a decline in the housing market for building starts as what we were expecting. Reconcile this for a moment. It's really difficult, but then we're going to talk about the cross. We're in a technical recession. Inflation is still crazy high. 55% of you, based on my Twitter survey, think that we're just in a stock market, bear market rally. And 45% of you say, no, the bottom is in, we're going back to the moon. But the point is, there's a lot of confusion out there. How can inflation still be so high? But consumers still spending and industrial production still going, but signs that inflation will come down being so good. All of this kind of relates to, it's actually good news. And on the housing side, we get this terrible news, but year over year home prices are still up. How do we put the pieces of this puzzle together? Because this is by far one of the most confusing times that we are living in. And you cannot be blamed for feeling confused in this environment. You just absolutely can't be. It's crazy. And it's so hard for people to time the market. If you could even remotely time the market successfully in this insanity that we're going through, you basically deserve a course on stocks and psychology of money. Because, oh my gosh, it is crazy. There is, by the way, a coupon code for that expires on August 26th. Link down below along with a real estate investing course. Now, let's talk about the cross. This is the important part, and we're going to put some dates on this. We haven't done this before with actual dates. So here's my belief, okay? We're going to go now from the data and explaining things that are happening to now my opinion, okay? This is me taking all of this data and trying to put it together in a simple, not overwhelming manner so that we can kind of picture what the HE double hockey sticks is actually going on out there. And the fact of the matter is, it's not all doom and gloom. It's not all FUD. It's just the reality of what's going on. So the red is going to be the stock market. Here's what I believe that we had. First, let's go ahead and draw some dates here. This over here is going to represent November of 2021. This over here is going to represent June of, come on HDMI cable, partner with me, 2022. And then we're going to draw a little curve here, right? This makes sense. We've all basically experienced this insanity, right? This is roughly what we've seen so far in the stock market. This to here represents about a 38% retracement. Doesn't actually mean that the NASDAQ, for example, moved 38%. From like a technical analysis point of view, it's an important number and an important level that we've crossed. We've actually crossed that level. It's about 318 on the ticker symbol QQQ, which is an ETF that follows the NASDAQ. Don't worry about that, okay? So we've gone from this crazy high in November of 2021 to this crazy low of June of 2022, and we've retraced. Now, it's possible that we could have a double dip, right? We could see a double dip, and then we should see some kind of continuation, right? I believe that this is quite likely that we'll face some kind of shorter term dip. I don't know if that dip will be as low as what we saw in June of 2022, but we will almost always have some form of other dip like this. I believe that. I also believe, and you could have a different opinion of this, that this will probably be higher than June of 2022, just because earnings are coming in stronger and production is coming in stronger. Yes, that creates a little bit more fear that, well, then the Fed has to be more evil to us, right? Not while inflation is trending down. If CPI numbers in September, inflation numbers in September come in bad, yeah, then maybe we hit a new low. I agree with you. So I don't want to feel like I'm alienating any of you thinking I have a different opinion of you. It's going to depend on CPI, and I think we can all agree on that. Okay, so when do we break? When do we basically moon again, right? In other words, when do we break November of 2021 levels? Well, personally, I believe that is going to occur between Q1 and Q2 of 2023, which means I don't really care to be perfect about timing the stock market here or here or here or here or here or here. I don't need to do that, okay? I've already played it, and I'll tell you, it's very, very stressful. I sold about here, and I rebought about here, okay? Right, and then also more here. These are roughly the places I bought, right around when we get to that support level, which I guess we haven't really gotten to that dotted line yet, so I should really put it like more like there. There we go. All right, so I went from here to here and here, okay? I feel comfortable about that, but that's just me personally. That doesn't matter so much. What matters instead is the forward-looking information. And that's that I believe we have this real potential of hitting these levels again in Q1 and Q2 of 2023. Now, why would I say that? Well, I say that because I think we're going to, in that quarter, in those two quarters, going to be comparing back to a whole of Omicron 2022 and Q2, oh crap, we could be going in a recession, the bottom of consumer spending. So comparing year over year should be beautiful for 2023, looking back to 2022. And that's why I believe the stock market could hit all-time new highs in Q1, Q2 of 2023. Now, what does that have to do with the Great Cross, right? All right, well, this is where it gets fun. Let's talk about the real estate market. So the real estate market is very, very interesting because the real estate market took a little bit longer to peak. The real estate market actually peaked tentatively, and we don't know, maybe it'll keep going up, but so far it's not. The real estate market actually peaked in about March of 2022. That's interesting. So let's kind of draw that. So we draw the real estate market here, okay? Now, we're right now in August of 2022, and so far we've seen real estate prices come down about 3.5% in closings, though we already have indications that that is going to be even more severe, probably going to be 10 to 25% off of peak, and that might be disputed, but that's my opinion. So this brings us off peak to August of 2022. Now, there are a few things that could happen here, right? 10-year treasuries could fall, which they're not right now. They're pretty much stabilizing around 2.8, which means mortgage rates should stay high, and we could go right back up, right? But that's not actually what I believe. I believe, and I apologize for this phenomenal HDMI cable, or it's the Apple dongle, in which case short Apple. But anyway, here's what I believe. I believe that the real estate market is much more likely, because it moves so slowly, to take a lot longer to bottom. I actually think the real estate market is more likely to bottom somewhere in after we get the year-over-year comps. So remember, Q1, Q2, we're going to be looking back into a hole for the stock market, but we're going to be looking back at a peak for the real estate market. That means in Q1, Q3 of 2023, we're actually going to see the biggest year-over-year decline in the real estate market. But that could lead to some additional fear that there's more pain to be had. And this means that we could actually see real estate prices realistically bottom in closer to Q3 to Q4 of 2023. And I think peak fear, so this right here I feel like would be representative of roughly a bottom, but then peak fear, which generally precedes a bottom, would be more like Q2, maybe Q1 of 2023. And so this means I believe the real estate market is likely to do this, and then for us to see sort of that dotted line up. Which, if you now look at this chart, you'll see this incredible crossing where the place you probably want to hang out for the next year, no guarantees, this isn't financial advice, I'm not your financial advisor, right? I'm not even a financial advisor. I'm a dude on YouTube. The place for you to hang out, in my opinion, is probably this slope right here, which yellow is probably a bad color to use since that's the background, but this is probably the place for you to hang out while that happens. Let that intersection occur. Let that crossing occur. And then when stocks hit highs again or start beating highs of 2021, now start taking profits from here and dumping them into real estate. That's my belief. Now, I could be wrong, but I'm one of the few folks, I believe, who is all in on both stocks and real estate. And this is what I'm seeing. And that's why, yeah, I have programs on building your wealth. Whether you want more of my perspective on stocks and my alerts when I buy or sell things or diversify more or less, great. For example, when I opened my M1 Finance pie, a new pie for all course members that we created, we're up over 40% in the thing since I first threw nearly 500 grand into it. This is an opportunity, but no guarantees. We're also diversifying, or we'll be diversifying a lot from Tesla once numbers get to certain thresholds. And if you want those alerts to see exactly what I'm doing, join the Stocks and Psych group. If you want to join the real estate group and learn how to become a wealthy investor in real estate in an easy way, how to deal with tenants in an easy way. You know, people always say, oh, I hear tenants and toilets are hard to deal with. We have ways to make it easy to deal with. We barely had to ever spend time on our tenants. We made it very easy because we have the tricks to make sure it's easy. We can teach you those. Anyway, check those out in the programs down below. Thank you so much for watching, and we'll see you in the next one.